Welcome to today's session. Today we're going to take a look at working capital management. Working capital is a very important part of the analysis of companies. It's a very important part of the management of companies. Working capital is typically a very large part of the total assets that are under management, and mismanagement or good management can make a substantial difference between success and failure. In particular, small companies are very susceptible to failure because of poor working capital practices. How well a company manages its inventory, if it has too much or too little, how it manages its accounts receivable, the way that it collects from its clients. These things can make a very big difference. It's also usually a very big part of the funding requirement. When companies go to the bank looking for cash, it's usually because they need money to fund their working capital. And that's why we spend a fair amount of time in this course looking at this one particular topic, and we're going to focus on a couple of tools in particular. The days inventory, the days accounts receivable, days payable, and how this creates a cash conversion cycle. We'll look at things like inventory turnover as well as a part of this, and the general management of our working capital. We'll start off with a story, an example. This is a company that I first saw during the early 1990s when I was doing an analysis of several banks' clients in the small business portfolio. A Scottish bank hired me to travel around Scotland and to interview business managers to look at their businesses and to produce video case studies for a course that I was setting up for them. One of the companies that they highly recommended was a brand new business set up a few years earlier in Midlothian. Now, that's the area between Edinburgh and Glasgow. And this company was in a region which had been hard hit by closures of coal mines and the steel business, and had been able to get some money from the government to create new jobs. The bank had become an important part of their business because they needed working capital financing, and they were constantly going back to the bank and asking for more money. The bank had not minded giving them this extra credit because it was a fast-growing business, and it was a remarkable success story, at least in most respects. When I first looked at the company, they'd been through a period of sales growth that was remarkable. From the first year to the second year, they grew by about 140% sales, 345 in the second year, and about 220% in the third year of business. And every year they'd had to actually relocate their business to larger premises. Their product was a very simple and very successful one. They made very small cakes, typically a fruit cake covered with a marzipan icing. And on top of the cake, there were usually sayings like happy birthday or congratulations, happy anniversary. Companies would give large orders to Sugar and Spice to produce cakes for their clients on events like a new product launch or a company anniversary. So their business had thrived. It was essentially managed by two people, husband and wife team, Elizabeth and Werner. Elizabeth was the business manager. Werner was the baker. He was a professional baker with lots of experience. And their business employed as many as 100 people during peak times of the year, producing these very small cakes. A lot of the product was handmade. A lot of the handwriting on the cake was still done with icing bags. And their business was essentially very labor-intensive, which suited local conditions, although that could possibly become a problem in the future. Their working capital needs were substantial because they had to have raw material inventory. They had to buy in bulk. And this is one of the things Elizabeth told me she was very proud of. She would get very good prices because she would buy large quantities of flour, sugar, candied fruit, and so on. And they had a large stockpile in their warehouse. They even had a stockpile at home in their garage. The accounts receivable came from their clients who were franchise card shops, but also department stores that were buying their product, taking credit and then paying them back according to normal credit terms and sometimes a little bit longer. Offsetting this, they had accounts payable, which were the demands of their own suppliers to pay their bills on time, and Elizabeth was also very proud that she paid her bills early. But to get back to some of the story, the company was also very profitable. They had excellent profit margins, and the gross margin was not only good for that type of business, but it was improving, which is a very hard thing to do during a period of growth. Their profit margin was not nearly as good, but that could partly be explained by their need to continually reinvest in new equipment and the increasing costs of depreciation as a result of that. Their overheads were also growing because they'd moved from a smaller to a larger factory each year. The rate of return on investment was good and showing significant growth and improvement in their return on invested capital. The problem that we saw, and we mostly saw this with hindsight, because my purpose in doing these case studies wasn't to do a financial analysis, but it was mostly to look at how to lend to small businesses. And most of the lending was done for the purpose of financing working capital. Their line of credit had gone from being something like £10,000 to £100,000 to £200,000 in a few short years, and that put it out of the limit of the local manager's discretion. They had have to kick the decision up to regional managers and then on to head office. And so the working capital funding requirement was becoming a significant issue. And you can kind of see why when you look at some of these days ratios. In this table, we can see their inventory started off in 1991 at about 43 days inventory. That means the raw materials, the work in progress, the finished goods inventory totaled to 43 days. Now, raw material is part of that, but remember the raw material is priced at cost. So we've got sugar and flour, which will eventually, perhaps 30 or 40 cents of sugar and flour go into a $5 cake. That's a small amount. It's got a very low weight on it. The work in progress similarly includes elements of labor now and is priced at a little bit higher rate. And the finished goods price, well, again, still it's a high value added product. So this is a surprisingly large number, 43 days, especially when you think it's a cake. And a cake has only got a certain amount of shelf life. Now, keep in mind it's a fruit cake, and fruit cakes can last for almost forever. The only thing that would give them a limited shelf life is the stability of the color in the icing. By 1992, they're up to 58 days. By 93, still 58 days. But 1994, their inventory has risen substantially. And I'd asked Elizabeth about that when I was visiting, and she said that was because of the need to diversify their product. Not only were they producing cakes, they were producing things like marzipan roses, which would require a lot of time to produce and would mostly sell around Valentine's Day. So that was part of the story for the day's inventory, but that was still a very large number. The accounts receivable. How many days does it take for the clients to pay their bills? Well, typical credit terms would be, say, net 30 days. That means we expect that our customers who take credit are going to pay in 30 days. If half of our customers pay us in cash, the average should be half of that. So it should be 15 days. In this case, their clients, the stores that they sold to, would pay them in 30 days, and I don't think they had any cash customers. And some of the bigger clients would pay slow. And that would be part of the problem of running a business like this, having to talk to your client and say, will you take a larger order next month? And say, oh yes, can you pay us for the order that you took last month? And so if there's a joint pressure of making sales and collecting your bills, quite often sales wins out. You can see that by the time we get to 1994, the days receivables has gone up to 92 days. And we also call this days sales outstanding. That's an awful lot of working capital already. It's partly offset by the accounts payable. The accounts payable in this case is the supplier costs that we pay with credit. For example, if we get flour from a supplier and we pay the supplier in 30 days, that would be part of our accounts payable. In this case, Elizabeth says that she gets discounts by paying early. So she pays her bills very quickly, and it starts off at 23 days, and by the time we get to 1994, she's paying her bills on average in 5 days. That's kind of good news and bad news. It allows her to take advantage of discounts, but at the same time, if she's borrowing the money from the bank in order to pay her suppliers, that could be very bad news. Still, that's a question we can't solve with the information that we've got. But what we can see here is that we have an idea of the cash conversion cycle. And our cash conversion cycle in this case can be seen to be the days inventory plus the accounts receivable. So in 1991, that's 43 plus 50. That gives us a 93-day operating cycle. From that, we subtract the accounts payable of 23 days. That means we've got 70 days. 43 plus 50 minus 23 gives us 70 days of our cash conversion cycle. How long it takes us to go from, well, the bank's cash into a finished product, sell the product, and collect net of the accounts payable. Now, 70 divided by 365 can also help us to express this as a percent. And we can use that as the working capital or net working assets divided by sales. And that says 19% of our total sales is tied up in working capital. It also means that if we've got to borrow money from the bank to fund another $1 million worth of sales, that means we're going to need 19% of another $1 million in working capital financing. And that's $190,000. That would be a fairly big amount to ask for your banker. By the time we get to 1994, you can see the picture's gotten worse for a number of reasons. We've got the increased inventories, we have the increased days sales outstanding. That gives us an operating cycle of 93 and 92. That's 185 days operating cycle. Subtract from that the 5 days of accounts payable. That gives us 180 days cash conversion cycle. 180 days to go from cash to inventory to account receivable and back to cash, net of the small amount of accounts payable. And if we divide the 180 days by 365, we get a number close to 49%. That means that for an additional $1 million in sales, we'll need 49% of that, or $490,000 in working capital financing from the bank. And there's a pretty good chance that the bank isn't going to provide us with that big of an increase in our credit. In fact, our bank manager is probably going to look at these numbers and say, Elizabeth, if you want to get more money from us, you're going to have to do something first. You've got to go and collect those accounts receivables faster. You have to get your inventory levels back down to where they were at least in 1991 so that we can start to look at how to finance the business. But the bank didn't do that. They didn't mention it to me when I spoke to the branch manager, to the regional manager. And nothing really good came out of this. The company was not able to finance its growth from the bank. What happened was that they ran short on some of their orders because they didn't have enough raw materials. They tried to collect their accounts receivables and they ended up losing a couple of the big customers. There were some other things that appeared to be going on in the business, but I really don't know, because when I checked up on the company again a few years later, they were no longer in business. They had failed. The bank was upset. The bank manager was in a lot of trouble. He did not want to talk to me about this particular account. The regional manager didn't want to say anything about it. In fact, he said he couldn't because the bank was in the process of suing the company's auditors. Now, Elizabeth and her husband had also been charged with fraud, misuse of shareholder funds, and the company had completely disappeared. For an exceptional product, this is a very sad ending to the story. If we were looking at this company and you said, what's the company's financial analysis look like? You'd say, fantastic growth, great profitability. In fact, even if you looked at things like the current ratio and the quick ratio, you could see that these numbers were good and they were increasing. And of course they were, because the current ratio is a ratio of the current assets to the current liabilities. And the main current assets in this case are the inventory and the accounts receivable, and they're going up much faster than the current liabilities or those payables. So the bankers would look at those ratios very carefully. In years afterwards, bankers were taught to ignore current and quick ratios because they tended to be misleading. When a company got closer to failure, its current ratio and its quick ratio tended to improve because the company was sitting on inventory they couldn't sell and trying to deal with accounts receivable that they couldn't collect, and offering even better credit terms to try to move some of that dead inventory. Suppliers don't want to give them any more credit because they're already in trouble with the ratings agencies and so on. The word's out, they're in trouble. Nobody gives them credit, so their current liabilities shrink. So you definitely did not want to look at those numbers. In fact, you could say that the company was highly leveraged because of the working capital finance, but it still had good interest cover because of its relatively high profitability. So in the end, a story that had, well, it in some senses was mixed. Here was a great product and a very interesting story about building a company from nothing, but it has a very sad ending because the company failed when it really shouldn't have. The bankers should have been in there earlier. Company management should have managed their working capital better, and I don't think that they really knew that there was a problem until it was too late. Some of the things that we talk about when we look at working capital, of course, are those current and quick ratios. If you ask anyone about ratios that they learned in school, those are probably the two first ratios they talk about. It's a historical artifact because bankers had been taught to do that, and by the time we got into the 1990s, partly because of some work that was done with the British Bankers Association and the American Bankers Association, emphasis on those two ratios largely disappeared. Unfortunately, that hasn't really affected our textbooks, which still promote the current and quick ratios. But remember, things like the inventory and the accounts receivable, while they demonstrate the company's ability to eventually be able to produce cash by selling off those things or collecting those things, also may represent dead inventory and accounts receivables that can't be collected. So extra interpretation is required. Those headline numbers might not be as useful as you used to think, or as we used to think. We also look at things like inventory turnover. That's a very helpful number if we're looking at industries that have seasonality. For example, a company that sells boats, a boat brokerage, will have a lot of inventory at the beginning of a season and probably much less in the high point of the season or at the end of the season. A company that produces or sells skis will have a high inventory at the beginning of the ski season and much less inventory at the end. If you're in the fashion business and there are 4 fashion seasons during a year, then we'd expect to see the turnover happen 4 times a year. Days ratios, which we've introduced in that earlier story, essentially are about how many days that we hold inventory. If you're selling bread, then probably we turn over inventory a lot, and you probably have around 360 times that you turn over that inventory a year, and you hold 1 or 2 days worth of inventory, but no more. If you count the raw materials, perhaps a little bit higher. If you produce beer and it takes 40 days for the beer to age, well, we'd expect that the inventory is going to be held at least for part of that 40 days. We also have to think about things like bottles that may be part of the inventory, raw materials which might be seasonal. So days inventory is a big part of the story as well. Days accounts receivables reflect normal credit terms and how efficient a company is at collecting those accounts receivable. We like to get our suppliers to provide credit because they don't charge interest. However, if we pay our bills too slowly, that could be a problem as well. We might end up with a bad credit rating. Our suppliers might cut us off. So if we have normal industry days of 30 or payables of 30 days and we're taking that for our raw materials, then that's probably a good thing. Overall, this helps us to create that cash conversion cycle that I described in the first example. Inventory, receivables minus payables gives us a cash conversion cycle. And so we'll look at that a little bit more today as well. Inventory is something that is carefully managed by some companies, not so carefully managed by others. In technology businesses, we don't want to hold a lot of inventory because it quickly becomes obsolete. It doesn't go stale, it doesn't start to rust on the shelves, but if you have a particular processor there's a pretty good chance there's a new one already under development. A company like Dell, for example, will try to manufacture its product at the time that it gets an order. It used to do that quite strictly. Before it started to sell the Dell computers through the big box stores, you had to go online to buy a Dell computer, and when they got your order and your Visa number, they would start to manufacture the computer for you, and then a week later it would probably show up at your door, having been produced with the latest parts. There was no old inventory to go stale. You can see this effect now when we take a look at the behavior of technology companies when they report their quarterly results. They try to show very low inventory. Sometimes they have been known, in fact Compaq used to be quite famous for this, they call it channel stuffing. And that's what this talks about in the Dilbert cartoon. The boss says we need everybody's help in the shipping department. Everything that sells by the end of the month is counted as revenue for the year or the quarter. More importantly, it's not shown as inventory. And increasing inventories would be a very bad sign to the analysts. So, and in this case, they don't have any inventory, and so they're shipping whatever's lying around. Imagine you're working in the receiving area at Best Buy and you're getting boxes that weren't ordered. You look for the purchase order to find out where these computers have come from. You call up your supplier and you say, "What's going on? I didn't order this stuff." And they say, "No, don't worry. It was a mistake on our end. You can send it back." Of course, then it will go back into inventory for the next quarter. Or they'll say, "Hang on to it and try and sell it. If you do, we'll give you a great price on it, and we won't ask you to pay for it until it's sold." Well, actually, you can't say that because then it becomes a contingent sale, and it really isn't a sale, and it shouldn't have been booked as such. Yeah, turnover of inventory is something that we record quite carefully, and here it's a very simple measurement: sales divided by inventory. So if we had $3 million in sales and 615,000 in inventory, apparently we have turned over inventory 4.9 times. And if you compare that to last year, from this textbook example, 2008, we had a 6.9 times inventory turnover. This year, less than 5 times. So our inventory turnover is falling, and that is a bad sign. Perhaps there's a problem with the product, perhaps there's a problem with our market or our distribution channel. Our industry average, according to this table, says the industry turns over inventory 9 times. And so we're doing much worse than the industry average. Or at least there's a difference. Perhaps our product is a little bit different. For example, if we're talking about groceries, and grocery stores turn over their inventory perhaps 25 or 30 times a year. If you're selling mostly frozen food, which has an incredibly long shelf life, then your turnover might actually be much lower because you hold larger inventories, and it may be that may be important because it's difficult and costly to ship frozen foods. On the other hand, if a competitor sells mostly fresh food, including things like ready-made salads, bread that's baked in the store, salads that are made in the store, and lots of milk and vegetables, then we'd expect to see more like 50 or 60 times turnover. Products like milk and bread might turn over perhaps every couple days. So the difference in the business relative to the industry might be shown from this turnover average, not just efficiency. So our comments on this particular case: inventory turnover is below average. Perhaps the company is sitting on old inventory that won't sell. Inventory control might not be as good. We might also be overstating the turnover when the sales are quoted at the market prices, but inventories are recorded at a historical cost. The problem, or one of the problems that we have with our ratio calculations, is that we're comparing the information in the numerator from the balance sheet. And the balance sheet is a stock statement. It tells us what our stock was on one day of the year. The information in the denominator comes from the income statement or from the cash flow statement, and those are typically flow statements that show the results from the first to the last day of the year. And so that's a flow, and we're comparing a stock and a flow, and that can lead to problems. For example, if we're recording information on the 31st of December and we had sold all of our inventory because of Christmas, it may understate our day's inventory by a substantial amount. If we were to record it on a day-by-day basis, every day of the year, and divide that by 365, that would give us a true measure of the actual inventory, the average inventory. But companies don't report 365 days of the year. So we could perhaps use the beginning and the end of the year information, the inventory on January 1st and December 31st. Still not much better. Take that information, divide it by 2. We could take it 4 times a year if we have the interim information and divide that information by 4. That would be certainly better. That is a problem that we would say is built in to this type of calculation. And it may be one of the reasons why companies report when they do, because it does make their company look better on that one time of the year. So we could use average inventory values instead of using the beginning and the end of period. We could use quarterly or semi-annual and divide it by the number of observations. Another important measure is the days sales outstanding. From our textbook, it tells us that we measure this by taking the accounts receivable. And sometimes this is just the trade receivables, not other kinds of receivables, and divide it by sales divided by 365. So in this example, if we have $375,000 in accounts receivable and $3 million of annual sales divided by 365, this tells us that the company collected their accounts receivable in about 46 days on average. Now, if our 2009 information says 46, last year we were collecting in 40 days, and the industry average was 36. We're doing worse than the industry on balance. We're doing worse than we were last year. And clearly there has to be an explanation. Maybe we've changed our product mix. Maybe instead of selling just one model, we're now selling 2 or 3. And we have a broader base of customers. We've sold to new customers who we haven't sold to before. Perhaps our customers are all using credit, and the industry, some of our competitors are selling for cash. So, and maybe the economy has gotten worse. Maybe customers in general are paying their bills more slowly. So it could be poor credit policy. If our credit terms are net 30 days and we're collecting now in 46, we're probably slipping a little bit. Now payables, in this case, you can see that instead of using our sales, we're using our cost of goods sold, because we don't buy our raw materials at the selling price, we buy them at the purchase price. So for this one, we take accounts payable, or average accounts payable perhaps, and divide those by the cost of goods sold divided by 365. In this case, we have 60,000 in accounts payable. Remember our sales were 3 million. In this case, our cost of goods sold 2,616,000. And that divided by 365 gives us an average daily sales of average daily cost of goods of 7,167. So 60 divided by that number gives us an average of 8.4 days. If the industry average in this case was 9 days, our company is doing better, paying its bills on time, than the average for the competitor. If it's significantly longer than the credit terms that are provided, we might end up in trouble with our suppliers, and we might end up paying higher prices for our product, losing out on discounts as well. If the accounts payable period is lower than the credit terms offering, we're not taking advantage of the free money that we get from our suppliers. And that's got consequences as well. If we have to borrow money from the bank and pay high rates of interest in order to be able to pay our bills on time, then that's not necessarily a good policy. Now, short-term finance is used to fund working capital. We get that money from the bank. That includes lines of credit, and also specialist financing that may be provided by suppliers. If you're in the automotive business, you probably get a lot of your financing from the automotive manufacturer's specialist finance arm, like General Motors Acceptance or Ford Motor Credit. A company called Alley provides most of the financing in that industry. So they'll help you to fund the inventory. You may also need help funding receivables if you provide credit terms down the line. And again, banks provide line of credit and revolving line of credit for that specific purpose. And of course, our receivables are at least partly funded by our suppliers. And if we can get more generous credit terms from our suppliers, we can fund more of our receivables with that money. Funding for working capital may depend on seasonality, position within a business cycles. Perhaps we're changing the way that we're doing business. We're adding new product lines, we're expanding into new regions, and that will require much larger inventory relative to the new sales that are generated. And there may also be timing issues within the year. If we want to sell goods for an important season, we have to build up our inventories well before that season, which might not occur until the next fiscal year. Credit isn't always used the way that it's intended. There are often going to be issues with the way that that happens. You can see the cash conversion cycle in this case presented as a timeline. Here we start off with cash at the very beginning of the cycle. On the left-hand side of the chart, we have got our cash, or else we have a line of credit from the bank. We use that money to buy inventory. Raw materials, we convert the raw materials into a finished good. We put those into our finished goods inventory and perhaps into spare parts. And then we sell them. On the day that we create a sale, we no longer have inventory, but we do have an account receivable. And so the account receivable has to be collected. In this example, we have inventory of 73 days, and then we turn it into an account receivable for the next 24 days. Our operating cycle is 73 plus 24, or 97 days that it takes us to go from cash back to cash. We can reduce that by the accounts payable, and we see on the bottom part, our accounts payable are 30 days. So our operating cycle of 97 days minus 30 gives us a cash conversion cycle of 67 days. So the total amount of time that it takes to go from cash back to cash is 67 days. We turn over our working capital, in this case about 6 times, almost 6 times per year. So that's the cash conversion cycle. The formula for this, inventory plus receivables, is the operating cycle. Minus the payables gives us the cash conversion cycle. A slightly more elaborate way of looking at this, we have raw materials which we purchase, and then we turn it into work in progress, and we turn that into finished goods. Companies with a lot of inventory may provide details of the different stages of inventory, and that can be really useful. For example, if you're looking at an avionics company, a company that makes electronics for aircraft, they need raw materials because they need things like silver, which they may buy when the price is low, or platinum, palladium. They have all kinds of specialist components that they need to hold. And you can't just go and buy one resistor, one circuit board. You have to buy them in a certain amount of volume. So raw material might expand significantly before a big order. Work in progress depends on how long it takes us to manufacture, and that hopefully is going to be relatively consistent. But if we get many big orders, perhaps our work in progress is also going to expand. Finished goods are going to be broken down into goods for sale and perhaps spare parts. If we are changing over to a new type of product, we might end up having to hold inventory for 7 or 8 years or even longer. And so perhaps our finished goods inventory includes a lot of spare part inventory for different products that are no longer sold. If you get a breakdown of this information from the company, that can be very useful. But not every company is going to provide that level of detail. Now, of course, at this stage we make a sale, we turn it into an account receivable. That will, of course, depend on the nature of our channel. If we're going to be selling to very large stores, like my friends at Sugar and Spice did, those stores essentially pay you when they feel like it. and you phone them up and say, hi there, it's been 90 days. When am I going to see a check? And they say, oh, it's definitely being processed. You'll have it any day now. And it might be another 30 days before you get the check. And they say, well, if you don't like it, you can always sell your product elsewhere. But those large stores essentially have significant purchasing power. It's a very disciplined company that'll chase away one of its biggest customers because they pay their bills slowly. Net of accounts payable, that gives us either, back to cash or back to the amount of money that we need to borrow from our bankers. The amount of working capital that's employed in the business and the importance of working capital management is going to depend on strategic decisions that management make about things like the amount of cash balances to hold for the business, the amount of inventory, the amount of accounts receivable, the amount of accounts payable. Each of these has got an opportunity cost of not having the resource plus a direct cost of having that resource. If a company, for example, decides to choose a more flexible policy or a more restrictive policy, there are going to be implications on the way the business operates. In the case of a flexible policy, that would mean that the company holds large cash balances to take advantage of perhaps business opportunities, to take advantage of new sales, carrying large amount of inventories in order to hold on to a customer that might demand immediate supply, having liberal credit terms in order to keep some of those customers. A more restrictive policy would perhaps be cheaper to manage, but by holding low amount of cash balances, it may miss out on business opportunities. Small amounts of opportunities may result in lost sales, and perhaps not having credit may mean that certain customers who rely on those credit balances would leave the firm. We can see this relationship in a number of charts that look similar to the ones above. For example, on the bottom axis we have an amount of current asset. That could be an amount of inventory, days sales that are supported by the business. And on the left-hand axis, we've got the dollar value. The line that we see rising, that's called carrying costs, represents the costs in each of those cases. They're usually some kind of direct cost. For example, direct cost for inventory means the amount of money that we have invested in that inventory. But we may have other types of carrying costs as well. For example, we have to store those goods. We have to store the inventory. We have to insure it. We have to provide security. There may also be obsolescence and spoilage, the more that we have. Theft could be another factor. So if we start off with no inventory, we have no carrying costs if we're over on the early part of this line. And if we have too much inventory, we're probably way up here. We have spoilage, obsolescence, high carrying costs. Offset against these carrying costs are a type of an opportunity cost or a shortage cost. For example, if on this chart we're on this part of the line, we have very small inventories, but when a customer comes into our store and we haven't got what they want, they'll quite possibly leave. So we have an opportunity loss or an opportunity cost. That may also affect our reputation, perhaps. On the other hand, if we have very, very large inventories, we're going to see smaller shortage costs. But one of the interesting things that you'll note about this line is that it's curved. There's going to be a very steep opportunity cost if we have significantly too little inventory, and there's going to be a relatively flat opportunity cost as we move over to the right-hand side of the chart. If you think about it, if you go into certain stores and you want certain things, for example, if I go into a supermarket and I'm looking for bread or milk, I'm not going to be, I would be very surprised if they don't have inventory. In fact, I might be upset and I might never shop in that store again. If I go into the store and I'm looking for a very unusual type of product, something that they wouldn't normally have, I would be actually very surprised if they have it. And I wouldn't at all be upset if they said, well, I don't have it, but I can order it and I can have it for you in a week. For example, if I go into an auto parts store and I want a windshield wiper blade, I would be upset if they didn't have it. If I went in and asked for a carburetor for a 1932 Studebaker, I would be surprised if they could even get it. And so if they said, I can have it for you in a week, I'd probably be quite happy. So that the happy mean, someplace here in the middle, is where essentially the increase in our degree of dissatisfaction is going to roughly be equal to the expectations or the cost of holding on to that product. And by putting together the vertical distance on each of these lines, for example, if we're over here, and well, let me just change my cursor so that I've got a pen. If I'm over here on the left-hand side, and I take the vertical distance for my carrying costs and my opportunity costs, and I take the sum of those two, and I put that onto a point above. I do that for each point on my line. You can see there's going to be some kind of a happy point, a minimum point, where the total cost of having that current asset, the opportunity cost, and the direct carrying costs and indirect carrying costs are all going to be equal. That would be the optimal level of inventory, the optimal level of accounts receivable, the optimal level of cash. As we go through chapter 17 and 18, we see this chart repeated over and over again. And the steepness of these lines is going to determine whether or not it's appropriate to have a flexible policy or a more restrictive one. So, for example, if we're thinking about a flexible policy, we have relatively low carrying costs. Our goods don't become obsolete. We don't have to worry about theft. we don't have to worry about insurance and many of those other costs. So the slope of the carrying cost line is relatively flat. However, the slope of the shortage cost line is quite steep. If you think in terms of things like industrial machinery, if you're Caterpillar and your customer wants a bulldozer and you haven't got it, they're liable to go with the competitor. They may end up with a Komatsu one because they have a job and it starts next week. Even more seriously, if they need spare parts for that machine, they want those spare parts right now. So Caterpillar will hold very large inventories of both its main product and the spare parts, because there is going to be a very high opportunity cost in terms of lost sales of not having that inventory. The carrying costs may be relatively low because, well, the goods don't become obsolete. A 20-year-old bulldozer will still require parts eventually. So low obsolescence or spoilage costs, storage costs relatively low. And because there's a really good margin on products like that, that a 20-year-old part for a $20 part for a bulldozer might actually sell for $150. It makes it worthwhile for a company to carry that. So companies carry large inventories. This may be true as well for things like cash balances. It may be true for things like the day's sales. So all kinds of current assets. A restrictive policy is one where there are prohibitive carrying costs. The carrying cost line is quite steep. And even with a relatively steep shortage cost line, we have an optimal level of inventory cash accounts receivable that's more over towards the left. And that would predict a type of restrictive policy. So this is something that we're going to see. We see it as a major theme over and over again as we go through that part of the course or that part of the text. A policy for an ideal economy would essentially say that we're going to require working capital that is going to be funded by long-term debt and common stock over time, and perhaps in the short term we're going to have to borrow from the bank in order to fund our current assets. So current assets would typically be funded by short-term debt. A line of credit from the bank would fund inventory and accounts receivable. And as we go through the year, we might need to build up our inventories, and as we sell them off, we're going to end up at the end of each year, we'll end up with a decreasing amount. So at the end of our year, we would have worn our short-term debt down to nothing. We'd go and buy more inventory. We'd create more accounts receivable. And then as we go through the year, we wear that down. And over time, the increase slope in that line comes from increased equity in the business from our sales, plus an increasing amount of long-term debt that's held in proportion to the increase in equity. A more typical line for either a flexible policy or restrictive policy says that we're going to see the demand for working capital rise and fall. It's not going to be that spiky type of pattern, but one that's more modulated like this one. During the peak part of our season, we're going to have a high demand for working capital. And then as we trail off towards the end of the year, perhaps less. We're going to increase it and let it fall off. And that's going to be true no matter which approach you take. If you're in a more flexible policy, you hold on to more cash-like assets in order to be able to fund that. Marketable securities, government bonds, things like that are used. And as we end up in a position where we don't require so much inventory, we turn that back into cash, and then we use the cash up. And so during the year, we'll be cash positive. We'll run our cash down to nothing, and then we'll use that cash to buy more fixed assets, more working assets. In a more restrictive policy, we're going to use short-term financing from the bank to fund our working capital. So as we go through those waves, we'll increase our line of credit, we'll take it back down to nothing at the end of the year. A hybrid of this, or a compromise, says that for many businesses, they will end up with cash for part of the year, but they'll end up using their line of credit for the remainder of the year. In fact, where we have businesses with relatively low interest rates, it may make more sense to have a compromise in favor of a flexible policy, and if there are high deposit rates or high opportunity costs for that cash, a more restrictive one. Now, just thinking about cash again, we don't spend a lot of time in this part of the course talking about cash, but companies will hold large cash balances. If there are very low interest rates, then the banks may keep that money in cash. If there are higher interest rates, they'll put more of that money into government bonds. But we describe both types of things as holding cash because those government bonds can be turned into cash very quickly. The three or perhaps four reasons why companies hold cash: a speculative motive. They may see a need to take advantage of investment opportunities, going out and buying another company. So if you see that a company has $10 million, $100 million that are sitting in the accounts at the beginning of the year, that money may actually have been spent since the accounts were prepared in the acquisition of another company. Or perhaps the need to expand into a new market, to build a new factory. Those would be reasons why a company might hold on to larger cash balances. As a precautionary motive, one of the reasons why both we and companies would hold on to cash, need to hold cash as a safety margin or as a financial reserve in case of an emergency. Transaction motives: we carry enough cash in the business, just like you carry enough cash to meet your day-to-day funding needs. So if you go to the bank machine and you take out $100, that's because you expect to spend $100 before the next trip to the ATM. Similarly, companies will look at their cash disbursements and say that a normal rate of disbursement means we need to keep $1 million, $5 million, $20 million in cash for transactions. One reason that's less common now, but had been in the past, was that perhaps financial institutions required that companies carry compensating balances, so that if they would have a line of credit, and that line of credit was could be drawn down to, say, $100,000, they might have a total line of credit of $200,000, on which they would pay some kind of interest. So the compensating balances actually provided the banks with an opportunity to charge more interest on a smaller amount of funds that were actually given out to the companies. That was often the case when interest rates were restricted by governments, so that if the government said that interest rates can't exceed 7%, by lending $200,000 and only disbursing $100,000, they would effectively charge twice the rate of interest on the money that was in circulation. The right amount of cash for a business is going to be some kind of a trade-off of the carrying costs. The carrying cost is the opportunity cost, largely the rate of interest that's not earned, or the money that's not earned by reinvesting in more plant and machinery, if that's possible for the business. Higher interest costs suggest lower amounts of cash in the business. If the company has to borrow to hold cash in its business, then definitely it would not be holding much spare cash. The shortage cost is the cost of not having the cash available on hand, or having to borrow the money on short notice at very high rates. So other factors may influence the cash balance in the business. The company's ability to borrow, perhaps its ability to use marketable securities as collateral for short-term borrowing at low rates. If we have something like a repurchase market or repo market that allows companies to essentially turn their collateral, their government bonds, into cash quickly, that would make it easier for companies. Also, there may be scale economies in cash management. If a company is very large, it has a treasury department. The people in treasury's job is to make sure that the company's got the right amount of cash in the right place, and that balance always stays within a predictable range. And for that, we see these same kind of charts. The opportunity cost of not having enough cash in the business, represented by this straight line. The carrying cost, interest costs, perhaps storage costs for the cash. The trading costs, so the costs they're going to be associated with having to borrow money in short term, and the optimal cash balance will be the vertical distance between these two things. So in this part of the course, we've talked a little bit about working capital. We've said that working capital is a part of our overall asset management. We have fixed asset management, perhaps even human capital or human asset management. Working capital management is very important for companies that have to worry about things like inventories and accounts receivable. Not every company does, but that's certainly going to be part of our story. It is about the company's liquidity and solvency, but also about the asset management. We looked at the days ratios, and they tend to be more effective at telling us about working capital management than things like quick ratio and current ratios. The cash conversion cycle that we looked at can help us to be able to identify the parts of working capital that are managed well or badly, but perhaps more importantly, they can give us information about the amount of funding that's required for the business. If we're working capital intensive, if we have 180 days a year working capital requirement, an increase in sales means an increase in borrowing. Being able to identify optimal levels of things like inventory, account receivables, payables, and also cash is going to be a critical part of financial management. I hope this session's been useful for you, and I look forward to seeing you in our next class.